Well, oil prices are retreating a bit as investors are watching yet more political upheaval, this time in Iran. President Trump said he is, quote, looking at military action as an option in response to crackdowns on protests in the country. Joining me on this, Ben Cook, Hennessy Energy Transition Fund portfolio manager. And we're seeing WTI a little bit lower, but Brent a little bit higher. But Ben, it's been really interesting between Venezuela and now potential for change in Iran to not see that much change in oil prices. Have you been surprised by that? And do you think that that's going to continue to be the case?
Yeah, again, thanks for having me, Julie. I appreciate it. The move in oil recently, I think, is reflective of just maybe a moderation in the bearishness that we've seen, the potential for disruption that comes with either protests in Iran or potential disruption in Venezuela associated with the removal of Maduro. The reality is, though, is that the crude oil market is well supplied. And if you consider the continuation of OPEC's unwind of production curtailment and the growth we're going to see in non-OPEC countries like Guyana, Brazil, and Canada over the course of the coming year, I think the muted price action here is a function of the expectation of an adequately supplied market. So not really a big surprise.
So you look at specific companies. That's what you do. That's what your job is. I want to ask you about one specific company, and that's ExxonMobil, because as we know, some of the oil executives met with President Trump last week. He's encouraging them to invest in Venezuela. And Darren Woods, the CEO of ExxonMobil, said Venezuela is uninvestable, right? They had invested there, had their assets seized. They've been fighting to get reimbursed for that for quite some time. And then President Trump sort of lashed back out at him. I mean, do you think that is an investing risk for ExxonMobil at all, this sort of back and forth about Venezuela?
Well, honestly, I think there's probably no better person or company, for that matter, to speak on the investability of foreign countries than Exxon and Darren Woods. I mean, they operate globally, places like Africa, even Papua New Guinea, some frontier areas around the world, and they're well aware of the risks and managing those risks and bringing large-scale developments online. The reality is that Venezuela holds great promise. I mean, the country was producing 3.5 million barrels a day before Hugo Chavez took over. And, longer term, I think, in order to revive the industry and grow production volume back to where it could be, Darren makes some very strong arguments. Look, we need safety guarantees. We need to ensure that personnel operating in the region are going to be out of harm's way. We need a legal system that promotes and protects the sanctity of contracts. And we also need a financial system that's transparent. We need to be able to follow the fund flows from investors into the projects that get developed and ultimately see the revenues make it back to the people of Venezuela, as well as the investors that have put that money at risk. So is there a risk for Exxon? I think they have a great portfolio of international assets. When the time is right and the risks are appropriate, they'll make the right decision.
Ben, leaving Venezuela aside, you like shares of ExxonMobil, right? And I'm curious why and what you think the sort of outlook is here. Energy stocks, I mean, Exxon did okay last year, but energy stocks sort of broadly have not really been in favor. So why do you like Exxon here?
Yeah, we like Exxon for a couple reasons. The integrated business model affords flexibility and commodity volatility. If crude oil prices are weak, typically the refining business can make up for that weakness given the lower feedstock costs, the better profit potential in the refining business. They also have a very attractive chemicals business, petrochemicals business that stands to benefit from low-cost feedstock as well. The company has a very strong balance sheet and obviously a management team that has demonstrated capability in investing through the cycle. And I think from an investor standpoint, one of the most attractive elements of the story really has been the shareholder return profile of the company. They pay an outstanding dividend that's been rising over the course of history. They also have a buyback plan that's robust. The stated plan is to buy back $20 billion worth of shares in the coming year, and will likely do so over the foreseeable future as long as Brent crude oil prices stay in the $60 to $65 range. So, we like it. Quality of assets, balance sheet management, as well as shareholder return profile is very attractive to us.
Ben, I'm curious how you're thinking about your fund is called the Energy Transition Fund. Are we still doing the energy transition? Is it still happening? And, these companies have, in some cases, invested quite a bit in transitioning. So where does this leave them?
Yeah, we've been undergoing a transition in the energy sector for decades. If you look at the shift away from coal towards natural gas and the proliferation of utilities in the primary fuel mix, the potential growth that comes with nuclear longer term, every day we're shifting towards a lower carbon intensity in terms of our consumption. And we think that's going to continue. For us, in terms of managing the Hennessy Energy Transition Fund, we look for the best opportunities on a risk-adjusted basis. So, for us, we continue to like the hydrocarbon space, given the cash return profile for many of the companies in our investable universe. Renewables will continue to make up a significant part of the primary fuel mix, and we'll continue to see growth in that area. We've preferred to steer away from some of those companies, given the policy risks associated with the Trump administration's potential rescinding of favorable tax incentives, the impacts of tariffs on foreign sourced components. Those are issues that we prefer not to, risk we prefer not to navigate. But over time, the market can change and the landscape will change. And the Energy Transition Fund and the broad investable universe that we're able to choose from provides ample opportunity to generate fairly consistent return going forward.